Hello and welcome to this video on the contribution margin. Cost volume profit analysis is a way that businesses will analyze what their cost structure or their cost behavior is and how it changes based on their volume of activity and how that influences the profit of the business. So there's some basic accounting identities listed below. First, we start with profit equals revenues minus costs, or we might say revenues minus expenses. We can then break our costs into the variable and fixed costs. So we can say our profit is equal to our revenue minus our variable costs minus our fixed costs. We can then say our profit is equal to the price per unit times the number of units we sell, because that's going to equal the revenue. The number of products you sell times the sales price equals your revenue. Then we're going to minus our variable costs. The variable cost per unit times the number of units we sell gives us our total variable cost minus the fixed cost. This identity is going to allow us to do cost volume profit analysis. So we need to introduce the contribution margin. The contribution margin is going to be something that we use a lot, and it's very useful for a range of decision making. So what is the contribution margin? The contribution margin is equal to the price you sell your products for minus the variable cost. The contribution margin indicates for every sale you make, how much are you contributing to your fixed cost. And once your fixed costs are paid off, it will indicate how much additional profit you will be generating for each sale that you make. So here, this formula, contribution margin equals price per product minus variable cost per product, is the contribution margin per unit. We can also express the contribution margin as a ratio, which would be the contribution margin ratio is equal to the price minus the variable cost divided by price. Both the contribution margin expressed per unit or as a ratio can be used in a very similar manner for similar analysis, but sometimes there's pros and cons of expressing it on a per unit or as a ratio basis. So the contribution margin is very easy to calculate. Because the formula is just the sales price minus the variable costs, let's have a look at an example of how to calculate this. If we have a company with a sales price per unit of $12.50, and they calculate their variable cost per unit is $9, then to calculate the contribution margin, would take the $12.50 sales price minus the $9 per unit variable cost and would get a contribution margin of $3.50. So for every sale the business makes, they're generating $3.50 to pay off the fixed costs. And once those fixed costs are paid off, that will all be going towards profit. We can also use the contribution margin ratio, the price of $12.50 minus the $9 variable cost divided by the price, means that our contribution margin ratio is 28%. Or for every sale you make, 28% of that is going towards paying off your fixed costs and then after that profit. We can express our contribution margin on a total basis or a per unit basis. Here we've got a game company, Happy Days Gaming. They sold 8,000 units of their games during the year for a total revenue of $100,000, or on a per unit basis, $12.50. Their variable costs were $72,000, or on a per unit basis, $9 per product, and their contribution margin was $3.50 per unit, or $28,000 in total. You can then minus off the fixed costs to get the net profit for the year. So let's actually practice using the contribution margin to make some. If this business, Happy Days, were able to increase their sales by 150 units, what would that actually mean for the profitability of the business? Because cost behaviors, variable and fixed costs behave in different ways, it's not as simple as just saying $150 times 150 units times the sales price gives us the revenue. We know that some costs will go up as our production increases and some costs will stay the same. So that's why we use the contribution margin to calculate the changes in the business. We know that Happy Days have a contribution margin of $3.50 per unit. If their sales were increased by 150 units, we could multiply 150 units times the contribution margin of $3.50, and that gives us $525. That means our overall profitability of the firm will improve by $525. We can go through all the steps below. The total revenues will be increased. Variable costs will be increased by $9 per unit. We can calculate our new contribution margin minus the $35,000 fixed cost, and we can see our net income here, or our net loss in this case, is $525 better, which is the 150 units times the $3.50 contribution margin. That's what actually changed the profit there. So calculating contribution margins, your sales price minus your variable costs is very simple to do. We have to be able to make sure we understand what our variable costs are and take the variable costs from the mixed costs in that calculation as well. And as we go forward, it's going to allow us to do a whole bunch of powerful things with our decision making. Next up, we're going to learn how to use the contribution margin to do break-even analysis. Thank you.